All right, I think we're going to go ahead and get started. I appreciate everybody participating this morning, or this afternoon, I should say. We thought around, since this is about the time that employers start receiving their unemployment tax rates for the next calendar year, it might be a good thing to go ahead and explain some, terminology and explain how you get your unemployment tax rate. There is some of our friends on the line here are actually from the school districts and stuff like that. I'll explain a little bit about the reimbursable status since that is how you pay your unemployment tax as well. So to get started here, here are some UI tax rate basics, okay? And there are two basic types of merit systems. And that is the merit system, meaning these are the types of unemployment accounts that pay the quarterly payroll tax. And the two basic types of systems are, one is the reserve account method, and that is a rate that is based on a ratio of the employer's reserve account balance divided by an average taxable payroll. When the employers pay their quarterly payroll tax for SUTA, they pay into a reserve account, and that is a balance that they maintain year in and year out. And that balance is based on contributions less any benefits paid, and that is what determines your account balance, okay? So then that account balance is applied to an average taxable payroll figure that changes every year during the calculation period of your UI tax, and that determines a ratio, and that ratio is what determines your unemployment tax rate. This method tends to avoid massive swings in rates because you're talking about an account balance that it grows and shrinks depending upon how you're doing in preventing unemployment from being assessed, as well as what is your contributions. If your contributions increase and your claim amounts are low, then that tends to keep everything at a low unemployment rate. It also can withstand if you have a year where you have a couple of claims that go against you for some reason, layoff or something like that. It won't completely tank your unemployment rate like some of the other methods can. The other method is called a benefit cost method, and this is a tax rate that's based on the ratio of the employer's assessed benefit charges divided by that average taxable payroll, okay? So this is a much more volatile system. It is directly tied to the amount of benefit charges that you can have in any given year. So Texas and Oklahoma, for example, are examples of this type of system. Kansas, Missouri, Pennsylvania, other states like that, those are examples of the type of unemployment, the reserve account method that I was describing earlier. Since these are tied directly to the amount of benefit charges that you receive in any given fiscal year, these can be a little bit more volatile because there's no reserve balance to distill it down. So if you have a really bad year and your taxable payroll remains basically the same, because remember, there's always a lag in the calculation. The calculations are based on a fiscal year. Most fiscal years end on June 30th, and the new fiscal year begins on July 1st. So when you're calculating your unemployment tax rate, you're looking at all the experience that occurs in the second half of the previous calendar year and the first half of the current calendar year. So what happens in the second half of that calendar year, 2017, for example, has no bearing on your unemployment tax rate for 2018. So there's a lag involved in that. So if you have a real bad first half of that cycle, and you're still maintaining you still have that 3-year average that's playing into it, you could have a real volatile unemployment rate based on the benefit cost method. While the tax calculations are based on a fiscal year, and the fiscal year varies a little bit from state to state, but most of them run from a July 1 to June 30th fiscal year. Your actual tax rate and the actual contributions that you make towards that your SUTA account are based on the calendar year. So as I was describing earlier, for your 2018 rate, it was the experience in the second half of 16 and the first 6 months of 2017, and that is what determines your unemployment rate for 2018. Okay, so there's just that lag in there that most people don't realize that takes place, but that is how they determine that. Now, there's some fine basic terminology that you need to understand in order to really truly understand how the calculation works. Taxable payroll, and this is one of the fundamental elements of the finance system that everybody uses. And this is the wage-based threshold that's determined by the state. We'll use Missouri as an example. The threshold, the wage base in Missouri is $13,000. Once you have paid that employee $13,000 in gross earnings, you no longer have to pay unemployment tax on that person any longer. And that is the figure, whatever figure that is per employee, whether it be the $13,000 wage base or it could be $1,000, that is what is rolled up to determine your average taxable payroll, okay? That average number that they use to calculate your unemployment tax rate can range from a 3 to 5 year average, depending on what state that you're in. For the purposes of Missouri, to use the example consistently, Missouri is a 3-year average, so is Kansas, okay? Most states are a 3-year average. There's a few out there that run on a 5-year average, but most states are a 3-year average taxable payroll. And whether you're using a benefit cost system or whether you're using a reserve account ratio system, it's that relationship, that average taxable payroll versus whatever number they use is what determines your unemployment tax rate. Now, benefit charges, that's obviously the single biggest factor in your rate calculation. How well you do at preventing unemployment charges, especially in benefit cost states, this is how you really go about keeping your unemployment tax rate low. Because if you keep the charges off your account, whether it be a reserve account system, if you use a reserve account system, all the taxes you pay into it will then stay in that reserve account. And then as the reserve account grows, and that creates a better ratio to your unemployment taxable payroll, that 3-year average. So as the better your ratio is to that 3-year taxable payroll, the lower your unemployment rate will be. Okay. Same would be with the benefit cost states. The lower your assessed charges are to the 3-year average taxable payroll will result in a better benefit cost ratio, and therefore that will result in a better, lower unemployment tax rate. So benefit charges, regardless of the system, are the absolute key element in this. Now, reimbursable employers, since there's a couple of school districts and maybe some other non-for-profit organizations, you don't pay any of this, okay? What you do is you're reimbursing the unemployment trust fund dollar for dollar anytime a former employee collects unemployment. So in lieu of paying the unemployment tax rate, this quarterly tax that I'm talking about here, you pay dollar for dollar anytime a former employee collects unemployment, whether that be you're the last employer or whether or not you are the base period employer. And if you have questions more about that type of system, don't hesitate to call or email me and I'll be happy to help you out. Okay. Now, one of the other key elements you need to remember, as I mentioned earlier, is that benefit cost ratio. And this is for those states who are in the benefit cost system. The ratio of the benefit charges and assessed to your relationship to your average taxable payroll, this is what determines your tax rate. That benefit cost ratio, whatever it may be, there's usually a tax table, and that tax table has a range of those benefit cost ratios. And then they graduate up depending upon where that range is. So it could be 0 to 1.5% and 1.6 to 2.5, whatever the tax table says. that benefit cost ratio then is applied to the tax table, and that's what determines your unemployment tax rate for the next calendar year. Now, account balance is what you're concerned with if you're a reserve account state, okay, Missouri and Kansas, for example. The amount of contributions, this is the amount of contributions that you have held in reserve in your paper account, okay, and any benefit charges are deducted from this reserve. So, again, it goes back to the fewer unemployment claims that you are assessed to your account, the lower your unemployment rate is going to be, because that ratio, that reserve ratio, the higher your account balance is comparison to that 3-year taxable payroll, means you're going to have a better reserve ratio. And again, just like the benefit cost ratio, that is assigned, that reserve ratio is assigned to a tax table, and then that tax table is what determines your unemployment tax rate for the year. So it's the same concept. They're just getting to that whole calculation in a different way. They're using, they're using the common taxable payroll figure, but what is the relationship is based on is two different calculations, two different figures. Now, what are the factors that are influencing the rate? Well, first and foremost, large increases in taxable payroll. Say you are a company that is in a growth mode, or you're just adding taxable payroll in general. That can result in a tax rate increase through no fault of your own. You could win all your unemployment claims, but if you add a substantial enough amount of taxable payroll, that can mathematically throw that reserve ratio or that benefit cost ratio out of whack. This is particularly important in reserve account systems because that taxable payroll is tied to the account balance, that reserve account balance. And when you increase that 3-year taxable payroll over and over and over, then it puts mathematical pressure on the reserve account to maintain equilibrium, okay? So for you Kansas employers, you may remember that they increased the taxable wage base from $8,000 to $12,000 to eventually $14,000. Well, it was artificially increasing your 3-year average taxable payroll from year in and year out, and it takes about 5 years for that entire cycle to equalize to where you're no longer seeing an artificial increase in your taxable payroll. So Kansas employers, because they were increasing the wage base and thus you were paying more taxable payroll per year per employee, you were putting, it was very difficult for those employers to maintain that equilibrium that is required. So you saw a artificial increase in your tax rate until all that equalized out. So that's a good example of what happens when you increase taxable payroll. It could result in an unemployment tax rate through no fault of your own. It's just the way the math is playing out against you. Now, benefit charges are obviously, I've talked about that before. Increases in benefit charges will always have, generally speaking, a negative, especially large increases in benefit charges. If you lay off 200 people, there's nothing you can do that's going to avoid an unemployment tax rate hike on you. Again, it is something that places all this ratio out of whack. It throws it completely out of equilibrium. So when you increase benefit charges, especially in a benefit cost state, remember, the ratio is directly tied to how many charges are assessed to your account year in and year out. So if you have a bad year, you have to lay off a bunch of people or you just lose a few claims, that's going to throw this completely out of whack for you because it's directly tied to the amount of benefit charges that you have. Okay. Finally, one that's completely overlooked usually is turnover. Again, remember, turnover means you restart that wage base every time you hire a new employee. So if your wage base is $13,000, every time you hire a new employee, regardless of where you're at in the year, you are adding to your taxable payroll because you're adding a new employee and you're adding new taxable wages each time. So large turnover, companies that have large turnover tend to create added pressure on their tax rate to maintain a balance of those of the wages versus the account balance or low benefit charges. In both cases, the way you combat that is you make sure that you win as many claims that you control your destiny in. Because if you're adding taxable payroll and you're increasing your contributions, as long as you keep those contributions in your account balance and the growth is steady and not sudden that throws it out of whack, you're likely going to be able to avoid a tax rate increase. Or even if you do have a tax rate increase, it should be only maybe 0.1%, something. Okay. Now, what the things you want to positively influence your rate: control turnover. Okay. Good hiring practices lower your average taxable payroll over time. You're not adding the new employees. You're not adding the new taxable wage base over and over and over. Okay. Identify poor performers early. Okay. Terminating individuals who you identified as poor performers within the first 90 days avoids benefit charges being assessed to your account. It's the way the calculation of claim liability occurs. For those of you who've been on my previous seminars, you'll remember that when an unemployment claim is filed, the liability is assessed to the individual employers that paid wages in the four most completed calendar quarters prior to the most recently completed calendar quarter. So if I was to file an unemployment claim today, the third quarter 2017 is the lag quarter. It's excluded from the calculation. The previous 4 quarters, the first and second quarter of 17, third and fourth quarter of 16, is what is used to calculate the unemployment liability. If you've hired that individual in the third quarter or the fourth quarter of 2017 and you've identified them as a poor performer, you can get rid of them. Even if you lose the unemployment claim, you're going to be assessed zero liability to that claim. So it doesn't impact your reserve account and it won't be counted against your benefit charges in the benefit cost statements. Okay. So that's something to keep in mind. The longer you keep an employee, the further you're extending the potential liability to your unemployment account. Low benefit charges equal lower rates. And as all you know by now, good human resource practices is key. Better the documentation, the better our opportunity is to present a winning case for you in the unemployment arena. Of course, proactive claims management, like what we're providing you through our strategic partnerships, that means we're winning more claims. And this is the quickest way to lower your rates, is to prevent the benefit charges from occurring. In both systems, this is the fastest way to keep your rates low and to lower them over time, because that means everything that you pay into that account, if it's a reserve account balance, it means that account balance is growing and it's looking better in relationship to your average taxable payroll. Your contributions are staying in your account. If it's a benefit cost date, you're looking at a very low benefit charge assessment versus your 3-year average taxable payroll, and that results in a lower unemployment rate. Because in both systems, the math is telling the UI Trust Fund, you're not utilizing, you're not digging the system, and therefore you should be rewarded with a lower rate. That's how the merit rated system works. So I'm going to open it up for questions and see if anybody has. You can type it in there. And if you don't have a question right now and you think of something later, you can always email me or call me. So does anybody have any quick questions?
Hey, Jeff.
All right. Yeah.
Hey, Jeff,
Mm-hmm.
This is Barry. I was just curious. The taxable income, as far as the average, you said that could be years in Texas.
I'm sorry, you broke up.
I'm sorry. I said the taxable income in Texas You said it's over a 3-year period?
The average is, yeah. Mm-hmm.
The average is, okay.
The calculation is that benefit charge total divided by your 3-year average taxable payroll in Texas. It's a benefit cost state, so it's tied directly to the the amount of charges you're assessed in any given year. All right. Well, hey, if there's no other questions, appreciate everybody participating, and we look forward to talking to you again soon. If you have any questions, my email address is right there, my telephone number. Don't hesitate to call or email me if you have a specific question about your particular account, because the rates will be coming out here soon.